Hello, everybody, and welcome back. Today, we have a special guest, Daniel Gladis, that just released a new book about capital allocation and how we can all become better investors. I think it's a great book, so we'll discuss the book, and I have a couple of questions for him. Hello, Daniel. How are you?
Hello, Christophe. I'm fine, and thank you very much for the invitation and the opportunity to discuss my book. I'm looking forward to that very much.
It's a great book for anyone who wants an early Christmas gift. Here is what you can have: hidden investment treasures, how to find great stock investments as the investment world goes passive. Basically, this is a very practical book. So this is very good for us because investing in stocks can be sometimes very complex. And congratulations, because you explain in very simple words how to invest in good quality companies so that you can perform good in stocks, how you can find opportunities in these markets. And sometimes opportunities are hidden. So hidden investment treasures. The book is a compilation of practical examples, real life examples. So this is the key difference between this book and other books. Specific companies that you have bought, you have sold at Voltava Fund, which is your fund. So yeah, this is real life. So clear examples from real life. Is this a good pitch of your book, or am I missing something?
No, I think it's pretty good. I think
Okay. Okay, so I have a couple of questions for you, but yeah, the book is about capital allocation decisions. So most of the questions will be about capital allocation decisions. It's a very important topic. It's the job of the CEO to allocate capital for the benefits of the shareholders. And some companies create value for shareholders. Over your career, what's the most important thing you've learned about how great capital allocators think differently from everyone else? What are they doing different from other CEOs, and how can you spot the best capital allocators in the world?
well, I think the best capital allocators are very patient because the capital allocation is not a matter of next quarter or next year. It's about efficient use of capital and long-term compounding. So I think patience is important characteristics. I think they are also very flexible because the opportunities come and go, and you should be able to adapt to changing world, to changing opportunities. Things change. You change your mind. You compare the opportunities you have for capital allocation at the moment. So flexibility is important. I think the good capital allocators are also aware of the opportunity costs they have, and they don't view opportunity costs as a academic calculation of cost of capital, for example, but they think that their opportunity cost is their next best investment opportunity that they have at hand. Because capital allocation is a relative game. You should always look for the best opportunity that you have at the moment. They usually think as owners, which you would say should be automatic, but it isn't. So capital allocators, when they allocate capital, usually it's other people capital, but they think and act as owners, as if it was their own capital. And I think when you look at them as personalities, I think for most of them, the temperament is more important than intelligence. You need to have actually very, very high intelligence is usually a red flag because people like that usually come with big egos. So the right temperament is probably more important than intelligence.
Yeah, maybe you want to avoid companies with a lot of charismatic CEOs. Maybe this
Yeah.
is
When people think they're bigger than life, usually it's not a good sign.
yeah. And you say CEOs should think as an owner of the business. Is insider ownership a must-have condition in this investing style?
It's a not must-have, but it's usually a good sign. Because managers are basically acting as an agent hired to run the company and allocate the capital by the owners. And sometimes, the agent principal conflict is definitely visible. So if a manager or CEO is also a big shareholder, that should alleviate the problem. Also, it's not necessarily always like that.
Okay. There is another topic on your book, in your book, about the rise of passive investing. So in your 3 decades of career in the investing field, you say the conditions for stock picking are have never been better. So what makes this period right now so exceptional for stock pickers?
Well, I don't know if it's exceptional, but it's very different than it used to be. When I was starting my career more than 30 years ago, the market looked completely different. Today, we have a dominance of passively invested money, especially in the US market, where most of the money is invested passively, which by definition means that there's a less and less of active investors. So the competition among active investors is getting weaker. Also, the market characteristics has changed. The price discovery process is now much slower and is distorted. It still works, but it's slower. And also, the uh, the rise of social media makes people act more impulsively. They now have the information is now being spread almost instantaneously all over the world, and people have a feeling that when they have all the latest information, they are the master of the information. They control the situation. But it's not about how much information you have. It's about what judgment actually you make based on information that you have. And people, instead of thinking, they because they can trade and act anytime, anywhere, just very, very easily. um, this hurts to impulsive excessive trading and herd behavior, which makes the situation for active investors that usually tend to think before they do something more favorable. And I really think 30 years ago, it was much, much tougher to be an active investor than today.
Are you saying that we have more information now, but less thinking because we are just flooded with information?
Absolutely. People sometimes think that the more information they have, the better, but that's not the case, because the ability of someone to process information is actually very limited. And if you start gathering information from zero, you very early get to the stage where more information is detrimental, because you lose sight of what's important, what is not, what is noise and what is information, what is valuable, what is not nonsense. And that breaking point is actually quite close to 0 point. So not more information is better. It's how you can handle information you have, and what judge how you are able to make a correct judgment.
And that will improve with time. With time, as you evolve as an investor, your analysis will get sharper over time. I
Should,
believe.
should, yes.
And you will have some mistakes along the way, but that's the life of every investor, I suppose. And based on this analysis, also a good point of your book is make things simple. If the analysis is too complex, you may be tempted to buy something and it's a mistake and you overcomplicate stuff. So you say the best investment cases should be done in your head. Can you give an example of a stock where simplicity actually helped you? Because a lot of people like the complex financial models. They like a huge Excel spreadsheets. They like to have a complex DCF model. They like complexity. They forecast many metrics at the same time. And you say most of the time that's a mistake to add a lot of complexity to your model.
No, I couldn't agree more. And maybe a good example would be company called OSB Group that I also talk about in the book. It's a small UK bank, and when I discovered the bank some time ago, what I saw was a bank that was doing relatively straightforward business. It consistently produced return on equity in mid-teens. It had very strong, good capital allocation with a lot of dividends, consistent buybacks, and the stock was trading at 2/3 of book value. So you don't really need to do a lot of modeling or calculations or projections, or hard thinking or whatever, to see that a bank like that deserves definitely valuation which is much higher than 2/3 of tangible book value. Because if a well-run bank can compound its book value at mid-teens, that's basically how fast your fundamental value compounds, and that deserves definitely more than two sets of tangible books. So that was a very, very easy decision then.
Plenty of buybacks, plenty of dividends, and the bank was fine. Why
Yes.
was the valuation low? Just sentiment or misunderstood?
You don't really find answers to questions like that. I mean, I often ask the same question, to myself when I look at various stocks. And well, first of all, the market is much more volatile than the fundamental value. I mean, when Robert Shiller did his famous study 20 or 30 years ago, he found that the stock prices are about 15 times more volatile than fundamental value
Yeah.
of the companies or the market. So by definition, you must have periods when the stock is too cheap and periods when it's too expensive, just by natural volatility. In this case, on top of that, it was helped by the fact that it's a UK stock, and UK is quite unpopular market. It's a small cap, so which a lot of people don't do, and it's a financial sector, so it's a combination of factors where the stocks are completely untouched by passive flows. So it was probably all of that combined.
Yeah, the UK sector is a hated country when it comes to investments right now.
Some reasons are rational, but some reasons are not, and I think it's a very UK market is a very good hunting ground for value stocks.
Yeah. Do you own any other UK-based company? Do you still own Crest Nicholson or
No, we don't own Crest. We own Burford Capital, which
yes?
is based in UK. We own SNU, which is also based in UK. And yeah, I think that's it. Yeah.
Okay, good hunting ground. Still looking at the opportunities over there. And there is another company you have in your portfolio called Alimentation Couche-Tard. Last time you came to this channel for an interview, we mentioned this big Japanese acquisition, and we didn't know at the time if it was going to go through. Turns out it will not go through. They will cancel the acquisition. And in the book, you have a complete chapter on the serial acquirer that is Alimentation Couche-Tard. So you also mentioned that doing a lot of acquisitions, that's risky because most of the times synergies don't happen. So what differentiates the quality of the management team for Alimentation Couche-Tard? What
Mm.
are the key signals you saw for this business that differentiate them from the rest? I mean, do you look at specific metrics, the return on capital or the debt level, the deleveraging or the behavior, the mindset of the management? How do you spot good serial acquirers from the rest?
Well, I look at all of these things, and acquisitions are tricky business because in theory, acquisitions can add a lot of value to the company, and if they're done well. But in practice, they are the biggest distractor of value because in most cases they are done at too high prices. They are not the expectations are too optimistic. It's difficult to integrate the businesses, etc., etc. So acquisitions are the biggest value destroyer. But if you can find a company that can do acquisitions well, that could be very good. So when I try to make a judgment, I look at a few things. First of all, I look at the process that the company is using. If acquisitions are standard way of their dealing, it's much better than if the acquisition is an ad hoc, crazy idea of a CEO. It's also important if they have a dedicated team that's working on acquisitions and has experience. Size of the acquisitions is always important because very large acquisitions usually are very risky and they don't turn out well. If the acquisition is paid by cash rather than stock, it's also better, etc., etc. So I look at the process that the company is using. I also look at the track record. And in case of Alimentation Couche-Tard, the track record of acquisitions is very long and very rich. And when I evaluate the historical acquisitions, and there have been tens of them, I can see that they have been consistent in that they don't overpay, they don't take too much leverage. when they integrate the new acquisition, it usually does better than before the acquisition. The size of the acquisitions are reasonable. They don't bet the house on single deal, and the track record is very good. And then thirdly, finally, I look at numbers. Typically, one of the most important metrics when I look at this an individual company is return on invested capital. And if the company is, when you look at the asset allocation, which is basically acquisition, then you also want to look at the return on incremental invested capital. The problem is that it's very difficult to calculate. So I look at long-term track record, and in the case of Alimentation Couche-Tard, you don't see, when you look at last 20 years, which is one acquisition after another, you don't see the overall return on invested capital on decline. You don't see big jumps up and down, after acquisitions. It's been actually very steady and very consistent, which is telling me that they're doing very, very good job. So we continue owning ATD, and I like the company a lot. And I'm actually happy that they didn't buy 7-Eleven, because the size of the acquisition was too large to my taste.
That confirms the thesis. You want the acquisitions to be at a reasonable size. If that's too big of a fish, that will hurt your business. And they didn't want to be acquired.
Also. Yeah, they basically didn't even engage in discussion. So that's probably good for us. And I think there's for Alimentation Couche-Tard, the combination of buybacks, which have restarted very fast after the 7-Eleven acquisition was called off. So combination of buybacks and combination of acquisitions in the size of single digit billions is probably a much better way to go forward. There's still a lot of potential to grow, and I think that's probably what they should do.
Yeah. Do they plan to do another acquisition? Did they hint?
No, they always they did one last year, but they always looking at some, and I'm pretty sure they're gonna be doing them.
Okay. Well, business as usual. Business as usual. I have another topic I want to cover. It's about Stellantis, because you mentioned Stellantis in your book. You talk about how cheap this business, this stock was, because that's a story from 2024. Since 2024, a lot of things have changed. The management team has changed. The CEO has changed. Any updates on this about your view? Do you still think it's a hidden treasure, or has your view evolved with this industry?
Yeah. When I wrote the chapter about Stellantis, that was in summer of last year, I viewed it as one of those big lever opportunities, large scale, multiple levers for improvement, market that was underestimating the potential, record margins, etc. But as I was sending the book to the press, that was in October of last year, the business was already deteriorating very rapidly in Stellantis. The leadership, the old former CEO made a number of mistakes, which led to leadership change and to strategic reset. The company was really underperforming across the board, especially in the US. Margins were under very strong pressure. So I was actually thinking to myself, should I leave the chapter in the book or should I take it out? Because there was still time to take it out when I already saw that the business is doing much worse than I expected when I started writing the book. And then I decided, no, I'll leave it in, because it probably, we don't know how the situation will play out in the next couple of years. But it's probably good to remind readers that even if you have well-researched ideas and convictions, you might prove to be wrong, very soon. And so I just left it in. And I wrote that, it was from all the case studies in the book, this is probably the one that is most likely to be wrong. And also our position in Stellantis was very small. And this is the only stock that we actually sold since I wrote the book. But the business seems to be stabilizing now, and maybe it will start turning up again. And so when I wrote the book, the stock was 12 euros, I think. Now it's between 8 and 9, so it's cheaper. But I would still, wait a couple of years to make the final judgment.
Yeah. Okay. Okay. Yeah. The change in CEO was quick, was fast, and things turned south very, very rapidly.
I don't recall a company, a large company, a big player in any industry, where the business would go south so fast, and as in the case of Stellantis.
When you are faced with this situation as an investor, you need flexibility. So you had the flexibility to change your mind, and this is good. This is good for transparency. Also for people reading this book, things will happen like this. You believe in one thesis, and then suddenly the thesis changes. You have to adapt to be flexible in your analysis. You have another company I want to mention about flexibility. It's about the oil and gas sector. It's about Cenovus, because Cenovus is a company in the oil and gas sector. They recently announced a large acquisition, and in the book, you praise the Cenovus for being disciplined about buybacks and rewarding shareholders with smart buybacks. And now it seems like they are stopping the buybacks to do a massive acquisition. And I remember in 2022 at the Praga Value Conference, the management was very clear. They say we want to deleverage a little bit, and once our debt is at a good level, we will use almost 100% of the free cash flow, excess free cash flow, to do buybacks, buybacks, buybacks. So now, if you are an investor or you want to be an investor, how do you judge this shift in capital allocation decisions? The same thing is true for Occidental Petroleum. I know I bought Occidental Petroleum because of buybacks, and same thing. They just stopped the buybacks to announce a massive acquisition with the debt, issuing more shares. Is this a yellow flag, or how do you see these changes in capital allocation?
Well, it's true that in case of Cenovus, part of my rationale for the investment was that the management is viewing asset allocation, as you described, so they want to return all the excess cash to shareholders in combination of buybacks and dividends, rather than trying to grow the business in absolute terms. But an interesting situation has developed. They were not, Cenovus management was not looking for an acquisition target, but they were actually served a very good deal on a silver platter, because one of their smaller competitors, Meg Energy, was approached by Strathcona Resources. Strathcona trying to do a hostile takeover. And Strathcona is it's quite an atypical company. It's more like a private equity business with very illiquid shares. And Meg Energy management didn't want to be acquired by Strathcona, so they approached Cenovus, whether Cenovus would be interested to buy Meg Energy. And I think the deal that Cenovus got is extremely favorable for them, because what they're buying, for in combination of cash and stock, they're buying Meg Energy for 7.9 billion, including debt. And the advantage is that it's probably no one else that would benefit more than Cenovus from this acquisition, because Meg Energy is not only very similar business to Cenovus, so it's in situ mining in Alberta, but their growth-oriented oil sands resources are right next to the resources of Cenovus. And in case of in situ mining, it's extremely beneficial when you have resources which is in one place rather than scattered all over the place. So I think this would no one else could benefit as much, because it's right next to each other, and there will be very large synergies, probably up to $400 million per year. And Cenovus will now become about 1 million barrels per day a miner. The acquisition would probably be closed next week. Now, of course, Cenovus would issue some shares. So in terms of share count, you would go back maybe a year or 2 years back. And to also incur some debt, because half of that would be paid in cash, which would slow down the buybacks. Because it would not stop the buybacks; it would slow them down, because they would now use half of the free cash flow or excess cash flow to return the capital to the shareholders, and half to reduce the debt. But at the end of last quarter, Cenovus sold their U.S. refining operations for up 1.8 billion, and they immediately doubled or tripled their buyback effort when they got that cash. So the share count is actually now shrinking very fast, before the acquisition closes. So they are aware of the fact that their debt would go higher, so only half of the free cash flow would go to buybacks, and the share count will also increase after acquisition. But I think it's very lucrative because I think the value per share of the business is now going to be bigger than before. So I don't see it as a deviation from the asset allocation strategy, and actually the management has reconfirmed that they don't change their views. But I see it as a great opportunity that they were presented and they used it. And I was actually very happy because there was some going back and forth between the two bidders, and I was actually very happy when Synovus got the acquisition at the price, which is still very attractive. So I have no problem with that. And I think the business itself will become more predictable and more stable, because I like that the fact that they sold the US refining acquisition operations, because the refining business is more capital intensive and more volatile. So now in the total mix, there will be much bigger share of the oil extraction and much smaller share of the refining, which I think is probably better.
So it will add more stability, and the management is clear. It's not a deviation out of the capital allocation. It's a extremely special situation, and you just take advantage of the situation.
Yes,
Okay.
I believe so. Yes.
Yeah. So in the coming years, we will see if they don't deviate. I mean, if they continue the buybacks over the years. Fair enough. Also, I want to mention something else. Let's change gears a little bit about Japan. Also, on the book, you mentioned the Japanese market. You are an investor in a Japanese index. You've been an investor for many years now. How has your view on Japan changed over the years? I mean, there are a lot of changes when it comes to governance. You mentioned this during the book, but I'm sure it will be pretty helpful to the viewers to understand how the Japanese situation has changed for the benefits of the shareholders. So that's actually bullish what we are seeing.
Yes, well, for most of my investing life, Japan was a classic example of unrealized potential, right? The country had some great companies, strong balance sheet, world-class engineering. I mean, the number of patents that Japanese companies have created over the last decades is incredible. But at the same time, there was very poor asset allocation and corporate governance. And so you had decades of deflation and some inward-looking corporate culture that meant that returns on equity were chronically low. Cash piles kept growing inside of companies. Managers didn't really act like owners. So for value investor, it was very frustrating. You could find very cheap stocks, but they stayed cheap forever because there was just no catalyst for a change. But that changed over the last 20, but specifically over the last 10 years, when both the stock exchange and the government was starting pushing for a change. And the change is happening, and it's not cyclical, it's really very structural. So the stock exchange and regulators and the government are pushing for improved price to book ratios, for genuine shift of culture towards returning capital to shareholders, for better behavior. So you see companies unwinding cross-sell holdings, unwinding the corporate conglomerate structures. The ownership of banks of the companies is decreasing. Companies are now doing buybacks at levels that would be completely unthinkable some years ago, etc. So yes, we have been investing. We like Japan very much. We have been investing there for 20 years. And, ROEs are improving. The earnings growth over the last 10, 12 years in Japan is much faster than in the US market. The market is repricing. It used to be much cheaper. Now it's not as cheap as it was, but the potential of changes is by far exhausted. And I think it will continue. I really like Japan. It used to be extremely unpopular market for a very long time. Now UK is the most unpopular, so
Yep.
Japan is now actually more in favor. I like Japanese market a lot.
And it is continuing to improve. I mean, do you think they will continue to reform the system to again have more pro shareholders measures in the future? Like, do you see this is a rising trend, or do you see some stabilization?
No, it's still a rising trend. This thing is still spreading, and the effect take time, at the level of companies for various reasons. So I would say we are still in the first third of the whole structural change.
Okay, that's big. That's
But
big.
long way to go.
Well, still early. Okay, potential good hunting ground if you find some good Japanese play over there. Also, Korea seems like the new government in Korea wants to improve the stock market when they want the stock market to go up. Do you think the same thing will happen in Korea? You have the almost the same culture of having too much cash in the balance sheet and not rewarding shareholders. Do you see the same thing happening in Korea, or is it still too early to tell?
Well, I assume you're talking about South Korea, right? So
Yes.
Korea is, I think, some people think Korea is at an earlier stage of the same evolution as Japan. So there are some parallels with Japan 10, 20 years ago. So you have a country full of globally competitive companies, often dominant in sectors like semiconductors, autos, batteries, shipbuilding, etc. And many traded single-digit multiples for forever, like for years and years and years. And you can argue that there's a very steep discount to intrinsic value. But the problem, until very recently has been really structural. So you had some family-controlled shareballs with some opaque structures, cross-shareholding, insider trading, limited regard for minority shareholders, etc. So you could see that a lot of capital and potential and value is trapped on balance sheet, and companies are under earning. But things are changing now, and so again, both the government and the Korean Stock Exchange have come up with they are recognizing this, and they have come up with a program called the Corporate Value Up program. It was launched last year, and it is pushing companies in the same direction as in Japan. So to have to improve returns on equities, to reduce cross holdings, to boost payouts to shareholders and buybacks. Now it's still very early. We're in year 2, but you're already seeing some large groups like Samsung, and their affiliates, SK Hynix or Hyundai, talking more about more transparent capital allocation and higher dividends, etc. So some people say, what Japanese do, Koreans do 10 years later, But I think if whether Korea truly follows Japan will depend on two things: whether on the consistency of the enforcement and on the real and permanent change of the culture inside of individual companies. Market seems to be appreciating the changes so far, because the Korean market this year has done extremely well, especially in the second half of the year.
Okay.
So we'll see.
Okay. Do you plan to invest some funds in Korea? Are you analyzing some Korean stocks? If you don't want to mention the names, don't mention the names. But are you doing some?
We used to own some Korean stocks in the past, but not recently. We are now looking at Korea again, but one of these negative or headwinds is that the stock market nearly tripled, this year. So things are not as cheap as they were a year ago, but we're starting to look at some Korean companies again.
Okay. Okay. Good hunting ground. Any other hunting grounds that you see for other countries that are improving the governance for the benefits of the shareholders, and any other countries that people underestimate? I mean, you mentioned UK already, but I don't know if you have any changes in governance for the UK. Any other countries you're looking at?
Well, I think the most changes that that are happening are in the emerging markets. So the countries I watch most are India, where SEBI has kept tightening rules on related parties transactions and on disclosure. In Brazil, there's ongoing revolution of B3's Novo Mercado, the premium garment segment. There's some refreshed listing regulations, etc. There's something going in Taiwan with the corporate governance roadmap. Saudi Arabia, Indonesia. Yeah, so the large emerging markets, they probably recognize that it's better for the markets, for companies, for the country in general to have some better, corporate governance and rules and regulations. Yeah, these would be the main examples, I think.
Okay. Plenty of countries here, and all the emerging markets are potential investment opportunities.
Poland is also a very attractive emerging market. Country that 30 years ago, where stock market was non-existent and for some time was close to foreigners, tightly regulated, etc. But now it's a very active market full of interesting companies with good corporate governance and good disclosure. So among the European emerging markets, this is probably the most interesting one.
Yeah, one of the best growing countries we have in Europe.
True.
Okay, here is the last question for my audience and for retail investors that want to become better investors. What are the lessons investors learn too late in life? So the kind of mistakes you want to avoid. Any specific advice you want to share with the audience?
Oh, it's a hard question. Let's see. I would say that investors should remember that time is the strongest force in investing, right? And people don't exploit it enough. Most people underestimate how much compounding depends on patience and long-term horizons. So that's probably one lesson. Investors often see volatility as their enemy, right? But volatility is not enemy; it's natural part of the markets, and you should approach it as something that creates opportunities. And so people should learn to analyze companies, but they should also realize that it's their behavior that's often their enemy. So they should also learn how to control themselves. What I have learned over time is that simplicity beats complexity. Especially investors that are early in their careers. We have maybe only several years of experience. They love detailed models, sensitivity tables, scenarios, analysis, and they think that some sophistication or complexity of their transactions is a proof of their level, right?
Yeah.
But it's the other way around. I think it's simplicity is not lack of sophistication, is actually the result of understanding. So I think you should definitely favor things that are simple rather than complex, because complex things are dependent on a number of conditions. Simple things are usually dependent on much less conditions. So there's like higher probability of success. Also, people should remember that, especially in today's markets, price and value can diverge for a long time. Okay, and that's the opportunity, right? But sometimes people give up because they think that the market is not recognizing fast enough their opinion, and they give up, quickly on some ideas. I think if it should be the other way around. You should be prepared that things might take longer than you expect, and if you research, if you base your conviction or your investment based on careful analysis and you trust your judgment, just stick with it. It should probably pay off sooner or later. The market is not your opponent; it's your partner. It's the analogy of Mr. Market that Benjamin Graham created. So market offers you prices every day, but you just don't need to respond every day. You just respond when the situation is extremely in your favor. And I think mistake that people often make is that they forget that investing success is personal, right? It's not relative. People spend their lives comparing their returns with others, with people they don't know, with returns of unverified, returns of other people, and they ruin their own strategy because they try to compete with someone. It's not the benchmark that matters. It's not how you do compare with someone else. Is whether the capital that you have is growing, and whether it is growing in a way that allows you to sleep well every night. So that's the way to approach the market.
Depending on your age, depending in if you are somebody with anxiety or not, your stress level, if you are busy or not, the goals are not the same. If you are 60 years old, it's pointless to compare yourself with somebody that is 25 years old. The risk tolerance is not the same. The time horizon is not the same at all.
Regardless of what you do, there will always be someone doing better, sometimes even much better, right? Sometimes people that you think are completely dumb will do much better than you. But that's normal, you know. So you should focus on yourself and focus on your own investments and stay relaxed, you know. You shouldn't get into stress or pressure to do something that would be dumb just because you're trying to catch up with someone anonymous, you know.
Great advice for the audience, for my audience of stock pickers. Okay, thank you very much for your time. For anyone who is interested in learning more about your new book, I will put the link in the description, in the pinned comment below, so people can directly read. You will have practical examples, real life companies, real life scenarios, and it will help you a lot to become a better investor. So thank you very much for your time, and I wish you a nice rest of your day. Bye-bye.
Yeah. Thank you very much, Christoph. And yeah, good. Thank you for the opportunity and all the best to you.